Ladies and gentlemen, and welcome to the show. I'm glad to have you guys here on this Thursday, May 4th, 2023. Thank you for tuning in. Listen, doesn't it seem like we're kind of like on the wild ride in Willy Wonka and the Chocolate Factory, where they went on this boat and everything seemed fine at first? But then as they progress, things get scarier and scarier. Well, it's like we got on this boat ride back in 2020. And we're all in it together. And the politicians and the rich people and the lawyers and all these people at the top, they're like Willy Wonka. And we're like terrified. We want to get off of the boat. You know, we want things to get back to normal again so we can walk on dry land, you know. Getting a little bit tired of all this nonsense that's been going on ever since 2020. What's going on? Who knows? There's so much skullduggery behind the scenes that it's kind of hard to sort it all out to figure out what exactly is going on. But anyway, I just using that as an analogy. Here, look at this. This is a lending tree survey that shows 46% of consumers in the United States are taking out these buy now, pay later loans this year. So in 2021, it was up 31% more people were taking out these buy now, pay later loans in 2021. And then this year, it's up 43% more. And what we're looking at is roughly almost half the people in America taking out these loans. Well, why are they taking out these loans? Well, guess what? It says right here on Fox Business. Americans using buy now, pay later to afford groceries. This is a crime. To make people so desperate that they would go to what was once referred to as loan sharks. I wouldn't really refer to them now as loan sharks, but a similar thing. You know, they're going to take something of yours that you might love so that you can feed yourself. And we're not talking about a small amount of people here. We're talking about 150 million people in America doing this, having to do this, being resorting to do this. Now, what comes 6 months from now or a year from now when they've lost what they love? Maybe they lost their nice car or whatever. Now they're walking, and they need to get groceries again. What do? They can't pay it, and they can't pay this. This is getting to be ridiculous, and it's affecting an awful lot of people out there. Tremendous. Okay, taking a look at this. Futures slide as Fed pauses rate hikes. Regional banks resume their plunge. Do you know there's like 2,500 banks in the United States right now who are in trouble? And the latest big one that's starting to go down is called PacWest, and it's a bank that's mostly it's the larger investors. It's the in PacWest. It's not your average Joe in PacWest Bank, you know, but it's a big bank, and it's another one. It's the latest one on the list to go. It says U.S. stocks were set to open lower, reversing modest gains earlier and extending a 3-day sell-off as investors weighed the possibility of more bank failures. Well, there's 2,500 banks ready to go down. So what does it say here? I'm reading on further. It says it says the S&P 500 has slid on Wednesday, marking its longest losing streak in nearly 2 months, even as the Fed signaled a possible pause in its most aggressive tightening campaign in decades. I said they shouldn't do it. When they were first starting this aggressive hiking campaign, I said no, but they don't listen to people like ordinary people like me and you. No, they do what they want to do. And what they want to do is make a problem, reaction, solution. This is how they always manipulate us into the position they want us to manipulate us into. You know? And that position they want to manipulate us into is anyway. Uh, don't go there. Okay, the stock slumped as much as 45%. Western Alliance is down 23%. So what we're looking at is PacWest investors. Uh, it says the stock slumped as much as 45% pre-market, and Western Alliance was down 23%, though it claimed it hasn't seen any unusual deposit flows. So what we're looking at is PacWest is probably the next one in line, but they're all in line, the banks, and they're going to go down one by one here. This is basically the way it's setting up. What if the Fed's lost control of all this? Well, I think they have. And it's their own fault because they didn't take a clue. I said they shouldn't do any of this, and now they've done it. And now what we're going to see is rubble. It says, when the bubble bursts, it's talking about the everything bubble, there will be no fourth or fifth bubble. There will only be rubble. And that kind of rhymes. And so it shows a big picture of rubble from an earthquake or something. Take a look at a couple of the fine points here. It says the U.S. economy and its financial system operate under the implicit belief that the Federal Reserve controls the direction of the economy and finance. The history of the past 30 years seems to support this belief. The flaw in this confidence in the Fed, is three speculative bubbles that have inflated and burst in the era of Fed control, from the 95 to the present. What few entertain as a possibility is the Fed losing control of the economy and finance for systemic reasons that have nothing to do with Fed policy per se. The immediate effects of the new Fed policy extremes is strong. For example, the Fed's trick of lowering bond yields interest rate. Participants can now confidently increase their exposure to risks at insane levels and dispense with hedges because they're confident the Fed will drop interest rates back to zero if the stock market falters. The confidence in the efficiency of the Fed policies can be understood as a buffer, providing resilience and a backstop. It's an awful position that they've got the Fed. The Fed's in an awful position, the Fed and the Treasury. I believe that they're going to have to backstop everything. But what if they didn't? You know? Then it would all completely collapse. Or what if they lost control of the backstop? In other words, what if things were to crash too fast for them to be able to respond? I know they can respond pretty quick. You remember at the beginning of the Silicon Valley Bank crisis, how quick they went into these meetings? Emergency meetings, they call them. And then they respond very quickly. But what if it's just a day late and a dollar short? What if the whole system basically just blows up or deleverages completely? And everybody goes bankrupt simultaneously. How would the Fed fix that? I'm just saying, guys. I mean, could they fix that? Could it be too big for the Fed even? You know? And them lose control completely and the whole system just lock up and they're not able to unlock it. I mean, there's a lot of questions here. We're in uncharted territory is basically what I'm saying. Gold today. What we're looking at is a price of $20.47. It's up $7.50. We're going to take a look at silver. Silver is up again 34 cents at $25.91. She's almost up to $26, guys. But the train still hasn't left the station. I'm going to be telling you guys, when it's $48 for silver, I'm going to be on here saying it's still a good value, guys. Your train hasn't left the station yet. When it's almost $50, I'll be telling you guys that on here. And that's where we're headed. But the train still will have not left the station, because what you guys got to really understand, what you really need to understand is is during a hyperinflationary event to the dollar, which is it's either that or the system's going to get crushed and the Fed's going to lose control and they can't stop it and the system's going to completely flatten. And in that case, you don't worry about it anyway. And why I say that is because everything will come to a stop because everything runs on money. So if the Fed really does lose control and they can't do anything to stop it and it just proceeds out of control and everybody goes bankrupt and the dollars just go vaporize and we go into some sort of a deflationary event like that, and the people that think they're holding cash, they think, oh, I can buy things for cheap on the pennies on the dollar. No, it wouldn't work that way. I'm sorry, but it wouldn't work that way because the system would cease to function. You need for dollars to be worth anything. It's kind of like, I know how to explain it to you guys. It's kind of like Bitcoin. For Bitcoin to be worth something, you have to have an internet. For your dollars, your Federal Reserve notes to be worth something, you have to have a running system. If the system freezes and the power goes out, grid goes down, and the telecommunications grid goes down, try to spend your dollars. Because the world's not going to look like it does now. If they lose control over this thing, what we're really talking about is the Fed completely loses control and everything just melts down. Like in 2008, they said it was threatening to melt down. If it really does melt down completely, the financial system, all lending stops, all banks, nothing functions. Because everything functions on money, or what we call money, which is Federal Reserve notes. And if they let it completely crashes and goes completely out of control, and they cannot do anything to stop it then at that point, then we're in a Mad Max situation, and then dollars ain't worth nothing. What's worth something then is food, water, shelter. The 3 Bs, That's what's worth something when the power grid and telecommunications fails. And that's all run on money. Everything in your life runs on money. What we call money is Federal Reserve notes. And so the Fed, that's why I keep telling you guys that they have to fix it. Our whole system depends upon them fixing it. And they know that. So they'll have their emergency meetings and they will try to fix it no matter how much they have to print. If the situation calls for it, if it's a $20 trillion crack up in the system. Okay, so it's going to take $20 trillion, $20 trillion to fix it, to get the system running again. What's the alternatives? They don't do it, and what happens? The system doesn't run again. It's ever. In other words, it's kind of like this. If you need something, if your car engine breaks, and I mean it really breaks, as in every piston flies out of the thing, you need a new engine. What's the alternative to that? Walking. So you either buy a new engine or you walk. And this is the way with the Fed. If this system breaks and it needs $20 trillion to get it running again, what's the alternative if they don't fix it? Mad Max world. For them too. So yes, they have to fix it. And that means printing $20 trillion. So there's always in this universe, there's a universal law, cause and effect. You've all seen those marbles, and they take the marble and they lift it up on this end like this, and they drop the marble, and it goes and hits the other 4 marbles, and then the one that corresponds on the opposite side moves. It's cause and effect. So they use then the $20 trillion to bail out the system, and now the system's running again. The effect is going to be in the dollar. The dollar will take a 50% haircut the first day. And then you get your move into hyperinflation. And then everybody will dump dollars around the world. I mean, this is the kind of place where we're headed with all this craziness. Taking a look now at the crypto markets. So we're doing good. We're holding up around 1.2 or 1.3 trillion in the industry. It's 1187 in billions. So that's 1,187 billion. And we're looking at Bitcoin at 28,940, so almost 29,000, and Ethereum at 1892. So they're doing pretty good right now, the cryptos. Let's take a look at the stock market. Well, first crude oil. Crude oil's down 47 cents. Now, this is an indicator. I told you guys. This is flashing red. This is indicating recession starting. Right now, recession starting. This is indicating the 68.13, under $70 price. Because I'm going to tell you, Saudi Arabia needs $90 for their budget and everything. And this is 68.13. This is undercutting the price that they need for oil. Dow Jones Industrial Average is down 325 points at 33,088. All in what the Fed's doing. Again. Move index today is 134.50. So move index is staying rather high. Bonds and rates. Now we're seeing craziness in the bond market right now. Look at some of these moves. 16 basis points in the U.S. 2-year at 3.77. And look at the size of the inversion. 5.4 on the 2-month. 5.44 on the 2-month. And all the way out to the 30-year, only 3.7. And so we're seeing falling yields on the long end today. 10 years at 3.33. It's fell 7.3 basis points. And the U.S. 30-year has fell, 1.5? Am I reading that right? Yeah, yields are falling really fast on the long end. Yields are rising on the short end, increasing the amount of the inversion, which is already a huge inversion in the yield curve. Taking a look at the dollar index today, 101.53, and it's going up today. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the next episode. Bye-bye.